Hi, I wanted to come to you today in the form of this video to explain some recent change going on in one of the major investments that we use here at Kennedy Wealth Group, because so many of you are invested in non-traded real estate investment trusts or REITs. I wanted to take this opportunity to mass communicate, if you will. So I want to share something that's going on in the industry. Just took place this week. As I tape this, it's April the 26th or something like that. I think it is today. I lose track of the days. We've been so busy lately. But just recently, the industry, the non-traded real estate investment trust industry, has undergone a change in the way that they report the value of the REIT on statements. Now, nothing has changed in terms of the investments, but the statements are going to come out looking a little differently when you get them in May. And here's what's happening. You know, when you invest, as we all have in REITs, we're direct investors in real estate. So when you do that, you have sunk costs that go into it, right? Makes sense. If you're going to buy a piece of rental property here in town or whatever, you're going to have costs associated with that. You might have realtors fees. I've got several listed out here, as you can see. You know, if you invest $100,000 in an investment property that you want to use for cash flow, you might have inspection fees of various sorts, appraisal fees, closing costs, loan processing, underwriting, loan discount, property tax, of course, is going to go into that, and then the selling commission or the realtor's fee. All those things can add up to be quite a bit. In this example, you might pay almost $15,000 for that kind of investment. And, you know, that's not a bad thing. It just is. It is what it is to get into that type of investment, to have a hard asset investment, if you will. You're going to have those expenses, and we all know that's the case. There's no free lunch. This is something we all understand. But to put an hard asset portfolio together like this, there are some expenses similar to this, different of course, but similar in that they take away from the dollars that go in the dirt day one. Now, that does not affect how you get paid on your investment. If you put that $100,000 into the investment and you get a cap rate of, say, 7%, whatever that might be, you're going to get paid that 7% on the full investment. Okay, so the cap rate is the same. Nothing's changed here. It's just that the way they're going to report the value here is going to be different starting in May. So for some REITs, it won't even matter because we've been in them long enough that they've built up, because, you know, over time, this real estate that you buy is going to build up in value because of either you bought it to have a value add proposition, you know, you fixed it up, it was a fixer-upper, a DIY project or something, and you gain value that way, or you waited a while over time, and just general appreciation brought the value up. But at the end, ideally, you want to get made whole because you sell for and get your $100,000 back, or maybe a little profit, ideally, right? Sell it for $105,000 or $110,000 plus the income that you've gotten along the way. So this cap rate that we buy at, 7% pays us $7,000 a year on the $100,000. Even though if we take out this $14,770, we're going to end up with just, maybe if we turned around and tried to sell this day one after we purchased it, you know, like the week after we purchased, the month after we purchased, we're not going to get all these costs back, right? So it's going to be, we might have to sell it for a discount, $85,000. Even if we sold it for this, we're not going to recoup these costs. So this is the value of the real estate. If you think about it, if you want to value it on a mark-to-market basis, then that's what it's going to be. So the industry has gone to this now to make it more transparent and say, hey, there's some fees here. We've all kind of known they were there. Now we're going to recognize them. So when you buy into a REIT, day one, the next month you're going to get a statement that looks like you've gone down in value. Now, they're not all going to be a 15%. They're going to be at various levels, but just so you know, I wanted to kind of illustrate a more or less worst case scenario. Really only about $8.50 of a $10 share price is going into the dirt, and that's what the industry is going to now show as the value. Okay, makes sense. However, your cap rate still being paid on the original investment. So if we're doing this for income, or if you're just reinvesting the dividends at a discount on the DRIP program, that dividend's being paid out based on your full investment value. So you're getting paid to wait for the real estate to appreciate or for the value proposition to manifest itself. And where else are you going to get 6 or 7 or 8% in today's marketplace? We like this asset class. We like that it's non-traded for a reason, but there are some unique characteristics of that, let's say. And part of that illiquidity is you've got all these fees and your value is not going to necessarily be exactly what you put in it. Hopefully that makes sense. If you have any questions at all, please feel free to reach out to us. Give us a call. We would love to answer any questions, but I was hoping to maybe address all those questions up front for folks, for you specifically, since you're an investor in non-traded real estate with us. Thanks for being an investor. Thanks for the trust and confidence you place in us, and we will talk to you soon.